Okay. హలో, వాయిస్ వస్తుందా? అట్లా. Yeah, Akash, now check my voice. Hello, Akash. So when it comes to the market value, the keyword we have estimated value. Next, when it comes to the liquidation value, means the keyword we have piecemeal basis. Piecemeal basis. So when it comes to the investment, the keyword we have is worth. And the word fair value represent actual value. Actual value or actual price. Actual value or actual price. The keywords you have to understand: orderly transaction between market participant at measurement date. Measurement date. When it comes to the fair market value, so the keyword is open market value. Open market value. Open market value. The keywords are reasonable knowledge as well as open market. So the equitable value means the value between the identified knowledgeables based on respective interest. These are the keywords we have. Multiple MCQs there, sir. Just sliceless differences. Sir, I shared my fifth chapter MCQs in group, sir. Please download it. Telegram. Not there. Module 3 is MCQs and case study. So next, when it comes to concept number 3, the highlightable points are DOLM and blockage discount. Every sentence is relating to MCQ. Not for exam question, theoretical questions point of view. Every sentence is a theoretical MCQ purpose only. The next, yeah, valuation premise. So the common valuation premises, the first one is highest and best use. We will check that asset give a more benefit for a less than 1 year or 12 more than 1 year. Highest and best use means more than 1 year. So for the purpose, you have to check physical possible, financial for feasible, legally allowed or not. So next one, current use or existing use of an asset or a security or a business. I'm not focusing about the future. I'm just focusing about the what happened within these 12 months. That premise is called current use or existing use, is also be known as is varies. So you can observe this sentence they used is the current way an asset liability is used. Current way means less than 12 months. Next, the point is important. The current use may be, but is not necessarily. Also the highest and best use. So here I am not focusing on the future. I am focusing only current is the meaning of that sentence. So maybe but is not necessary also the highest and best use. I'm not focusing on the highest and best use. I am focusing only on current use. Are you clear? The words are important. Maybe but is not necessarily. So what happened in this chapter means they're just taking the sentence. In between the sentence, they will cut the one word. They will ask as an option. Guys, clear? Next, orderly liquidation. So the premise name itself saying that liquidation. What does the word mean orderly? If court or government give a sufficient time to do the transaction or sold the asset, that is called orderly transaction. Now let us check. The orderly liquidation describes the value of a group of asset that could be realized in a liquidation sale. Give a what period? Reasonable period. To find whom? Purchaser. Not purchase, to find the purchaser. Are you clear now? Now when it comes to forced sale, the term itself saying that forced. I'm not giving any time to you. Please sell that property. Now the forced sale is often used under compulsion to sell. And that has any consequences. A proper marketing period is allowed or not possible? Not possible. And buyer may not be able to undertake adequate due diligence. Okay, done. When it comes to the important one, a lot of MCQs is there relating to going concern. Now the going concern value is the value of a business that expected to continue to operation in the future. This is a common sense. We learn from the foundation level. Basic accounting principles. One of the principles is going concern. Yes or no, sir? Now, used in valuation of what, sir? Intangible assets. Why? Because I said valuation of asset or a business or a security. The asset definition I'm not explained, but you know the asset definition. Asset has a two types of classification. One is long term, another one is short term. Now the long term has again two classification: tangible, intangible. Guys, clear? Yes, we have the concept. We have concepts also. Valuation of goodwill, valuation of copyrights, valuation of human resources, valuation of brand. This all covered under intangible things. Are you clear? At the time of doing a valuation of intangible things, you have to follow the premise name called going concern premise. Are you clear? So I think yesterday class we completed in a hurry up manner. Okay. So note one is an important point. Business are valued using going concern premise. In case where businesses are under stress, they may be valued on liquidation or forced sale premise. So it's a combined sentence, sir. You have to break it and read. So business are valued using going concern premise. Are you agree? That's one sentence. That's the mean they're using a word called under stress. If a company is good in financially, they're having a profits, they're earning a profits, they have a good current assets, they have a good fixed assets, they have a good performances. That time you can use a going concern premise. But if a company is stress, there is a concept name called Altman G score in chapter 4. So we are using for protecting the future health of the company. Are you clear? If it's a financially weak, we are using a word called the company in stress. Are you clear? The company current assets are 1 lakh rupee, current liability is 1,10,000 rupee. It's a financially good or bad? Bad. They're not able to meet their current liabilities. That kind of company is known as stress companies. Guys, clear? If it is a stress point of view, don't use a going concern. Why? Because if it is a stress means automatically we will shut down or close the business. At that time, use either orderly liquidation or forced liquidation premise. Note 2. Tangible assets are usually valued using any premise. You can use highest and best use, current use, next liquidation, orderly liquidation or forced sale. But don't use a going concern. Are you clear? Going concern only for intangible things. Are you guys clear? Based on this information, you have 7 to 8 MCQs in our material. Only based on this information. Above key terms is there na. Based on that, we have a 20 MCQs out of 75. Are you clear? Done. So next, we already completed this fair market value, investment value, intrinsic value, fair value, market value, etc. So book value means you know that. So what you recorded in your books of accounts in a historical nature is known as book values. Liquidation value also you know that you selling at piecemeal basis either single asset or group of asset. Now when it come to valuation approach, here also we completed in we completed, but you need to understand some more points in these approaches. So basically you know the approaches. Three approaches we have. One is market approach, income approach, cost approach. Are you clear? Now when it come to market approach, so value by comparing the assets with identical or similar or comparable assets in the market. You said already at day one class. So you don't know the name, but you said example. So how you value if there is a no proper financial information? Ask the question, then expresses the answer. I will compare with the another company values. Are you clear? Now that's not another company, it is called identical, similar, comparable assets. Okay, done. When it applicable, the common sense is involved. Sir, I don't have a financial statements, I don't have a balance sheet, I can't forecast my future cash inflows, I don't have a cost related my asset, cost of the asset. That's why if I can't use any approach or any method, that's why I will choose a company comparable. So market comparable traded in active market, first case. Comparable assets information fully available, second case. Comparable assets recently sold for consideration. If in these three cases we are using what approach? Market approach. Remaining all common sense. We are using this means I don't have a remaining approaches information. Guys, clear? Done. So under this we have a three methods: market price method, comparable company comparable multiples method, company comparable transaction method. I already expressed multiples means don't worry, it is a alternative name of ratios. So the word multiple means it's not a that much of difficult word, it's just a ratios. Clear? Done. So I'm not ready to explain about the entire approaches. Just I will give a clue why, because in 6 chapter total we discuss about these methods only. Now when it come to market approach, simply we are find outing V naught or P naught based on open market information. Just write it down. So market approach means calculating V naught or P naught based on open market values. Sir, can I value MR of company shares today? Can I value MR of company shares today? Or why you are taking that much of risk, sir? Go on search in Google. It will show value per share of today value share. Yes or no, sir? That's why I wrote open market values. Are you okay now? Now when it comes to comparable multiple methods, so just I'm giving a clarity here. We are considering observe. So for example, I am a steel manufacturer. Next there is a Tata company also there, steel manufacturer. Size point of view, employment point of view, and profits point of view, both are similar. But there are a listed company, they maintained a proper books of accounts. I'm not a listed company, I'm not maintaining proper books of accounts. Are you clear? I have some basic values. But I don't have a parameters to value. For the purpose of parameters, I will consider Tata Steel ratios. Are you clear? That's the way you are doing a valuation under comparable multiples method. So what are the ratios you are considered from the similar company means you will consider PE multiple, you will consider PS multiple, you will consider EBITDA multiple, you will consider PBV multiple. They are not the basic things here. PE multiple means PE ratio. PS means price to selling price ratio. MPS divided by SP, selling price per share. Don't write, sir, just understand. We will discuss in next chapter. PS means price to selling price ratio. Price to selling price ratio. So this ratio itself expresses enterprise value divided by EBITDA. You know the full form of EBITDA. Earning before interest, tax, depreciation and amortization expenses. Now PBV ratio means price to book value ratio. Price to book value ratio. By using these ratios, we are figuring out the value of an organization called company comparable multiple method. Now when it comes to comparable transaction method, I said at day 1 and day 2 I think, chatting app. It's similar to WhatsApp. So in India there is no similar companies. That's why I consider the transaction of the WhatsApp, I discounted 95%. Why? Because if it is 100%, I am equivalent to 5% only. Are you clear? That kind of transaction is known as a comparable transaction method valuation. So alternative name is very, very important. It's also been known as guided transaction method. Guided transaction method. Are you clear? Here we are using recent transaction happen in the market. Recent transaction, similar transaction. Not a similar company, just a transaction. Now, recent and orderly transaction. Recent and orderly transaction. Guys, clear? This is all about market approach and its methods. Just clear? Okay, done. Next, concept number 8. What is meant by income approach? So the converting future benefit into present value. Benefit means value of income, cash flow or cost saving. So in a simple term, what income approach talks about means it talks about future economic benefit. It talks about future economic benefit. You already learned future economic benefit. Future economic benefit we are not using for today valuation. Why? Because today value is not same as a future value. That's why we're bringing that future value to present. That's why in income approach we maximum using discounting. Maximally using discounting. So the word we are using benefit now, future benefit. That benefit may be income form, cash form or a cost saving. So income form means you already valued in a dividend point of view. Gordon's growth model, forecasted and terminal. You bring that dividend, future dividend into present value, na? Income point of view. Next chapter, you will do problems on completely on cash basis. Instead of D1 is there, na? You are using cash flows. Are you okay? Now when it comes to, here is a very, very important point, cost saving. For example, I am ready to purchase a MacBook. So if previously I am using a HP laptop for classes. Very clear. If I use the HP classes, these Apple gadgets are not suits the HP. That's why I need to arrange all things like HDMI cables, connectors. If I use that all things, then only I can explain the class with help of HP laptop and this tab. But now this gadget is a MacBook Apple product. This also be a Apple product. I can access easily. Very clear. If I choose this Apple MacBook, I will lose all the wires and connectors, etc. Very clear. So that's called cost saving. Benefit means not only profit, cost saving also a benefit. Very clear. So done. So applicability, when it is applicable, check the points. Asset does not have a market comparable and comparable transaction. So market does not have a market comparable and comparable transaction. So if I don't have any similar company information and similar transaction, I need to choose either discounted cash, either income approach or cost approach. Cost related information also not there. I need to choose income approach. Guys, clear? Now, asset is a income is a producing asset. So when you're doing a valuation, if that assets generate highest and best use, it means estimating revenue more than 1 year. It's called what? We can use a direct income approach methods. Next, future benefits known and certain. Generally, future economic benefits are we can't predict. We are just estimate. Are you clear, sir? If it is a possible, then go with the income approach. We have two methods: discounted cash flow method and profit earning capitalization or capitalization of earnings method. Guys, clear? Now, discounted cash flow method, there is no discussion. Converting future economic benefit into present value, you will receive two benefits, I think. One is from operation, another from terminal. You have a one outflow, you are incurring at initial point. Now, profit earning capitalization value. I already explained at the time of NI approach explanation. How to calculate market value of the firm. There is a basic version. EBIT divided by R, RKO. That is called capitalization model. I already expressed. Are you clear, sir? Done. Now, what is meant by cost approach? The cost approach is commonly used to determine the value of a property by estimating the cost of replace or reproduce the property, taking into account depreciation and obsolescence. Why? Because in assets point of view, very important thing you have to learn is depreciation and obsolescence. And if it is an intangible thing, you have to focus on amortization. Guys, clear? Now, applicability. When we are using cost approach, where the income or market approach can't be, yes, common sense. Asset can be quickly recreated with the substantially the same utility. So for example, it's a simple word: replacement. If it's similar replacement assets you have, you can use that cost as a valuation. Now, when liquidation value is to be determined by a court or not court, liquidator. Who will decide the asset values? Liquidator. Orders only imposed by a court, all process done by a liquidator. Now, when it comes to cost approach, we have two methods. One is replacement cost method, another one is reproduction cost method. So that's a yesterday discussion. Are you okay? Now, when it comes to valuation of risk and return. For the word of risk, we have one chapter name called chapter for enterprise risk management. That entire chapter talks about risk only. But you have to understand one thing: risk and return are very important aspects in any decision. Are you clear? So they're directly linked. So what they directly linked means, go with the equity point of view only. First basic example: if company have a more risk, are you expect less return or more return? More return. Guys, clear? They're directly related. More risk, more return. Less risk, less return. No risk, RF. At that case also, we can't use the word no, where you to use a word called low. Risk free. Are you clear, sir? Not zero risk. Are you okay? Now see, so return may be realized or what, sir? Expected. What we calculating KE, all these there na, they all called realized or expected, not actual. Realized or actual. What if you are solving a problem for a benefit calculation, that benefit is either expected or realized. Are you guys clear? It's not actual, realized and expected. Now when it comes to equity, shareholder get a return in the form of capital appreciation as well as dividend. If I invest 10 rupees on any equity share, I will expect two returns. What are the two returns? One is capital appreciation, another one is dividend. If I invest in debenture, I will expect only one return: interest. If it is redeemable, it is not a return. Point to be understand clearly. If I invest in debenture, I will expect only one benefit, that is called interest. If it is a redeemable, I am expecting capital, not extra benefit. Hope you understand. But when it comes to the word I used, capital appreciation is an extra benefit. Share price will be increase or decrease, but debenture not increase, not decrease. Now, guys, clear? Now see, where debenture gets a return in the form of capital appreciation as well as interest. Sir, what you explained, there is a no capital appreciation. Sir, you can understand clearly what I say. I said just about the capital. Just about the capital. But if you observe the calculation part of the KO, redeemable irredeemable problem, one we solved. On that case, we taken market price is repayment value is 105 and market price is 103, I think. Yes or no, sir? So if you repay at a more than market value or you repay at a premium, that premium is known as appreciation. Guys, clear? Maximum of the cases repayment done at face value only. If they done at face value, there is no extra benefit. Hope you guys understand now. So this formula I already explained at the time of KE calculation. Which model it is? Realized yield. Realized yield. Okay, done. So expected rate of return for any asset is the weighted average rate of return using the probability of each return as a weight. Put a star for this point. So when you are calculating weighted average return, we are not using simple average. We are using what? Weighted average rate of return. That's why we are calculating KO with help of weights. Sir, KO is a cost now. KO is a cost now. Why you are using return here? You can go and check the cost of capital definition. It is a minimum rate of return company need to earn. Guys, clear? Done. Now when it comes to valuation of risk, guys. So valuation of risk is nothing but in simple times, risk means possibility of occurrence of loss or not occurrence of loss. Risk means occurrence of loss. As for SFM, you learn that word. Risk means possibility of occurrence of loss. Very clear? Okay, then you can easily say like this: expected is not same as actual. Expected is not same as actual. The gap is there now, not same. The gap is known as risk. Why they both are not same means because of risk. Guys, clear? That's basic thing you have to learn here. Next, when it come to risk, can be defined as a chance that actual outcome from an investment will be differ from the what, sir? Expected outcome. So I expected 10% of return. It just the realization, the actual is just 8%. Both are same or different? 10 and 8 is different. Why the differences came? Because of gap is known as risk. Now the risk means possibility of occurrence of loss or uncertainty or deviation from the mean return. Can I use the word mean return is nothing but expected or average. So that's what they specified. Average, there is no average return, there is a weighted average return. See the point number last of return point. Expected rate of return for any asset is the weighted average rate of return. Guys, clear? Done. Now risk can be measured using variance or standard deviation or coefficient of variance. Now how to calculate this standard deviation, guys? Standard deviation is a measurement of risk, sir. Why you are using standard deviation means for calculating risk, for measuring the risk. Standard deviation equal to square root of variance. Square root of variance. So how you get a variance means you can simplify that. If you send the root into this side, standard deviation square. Are you okay? When it comes to first calculating of variance equals to x minus x bar whole square. If you have a more than one area information, go with the summation. If they give a probability, multiply with the probability. Are you clear? Okay. Next, when it comes to coefficient of variance. Coefficient of variance equals to standard deviation divided by x bar or our mean. Standard deviation divided by mean or x bar. Clear? Now, put a star for this point number C. Point number C. So this question asked in June 23 MDP for 3 marks. They framed one problem for 4 marks, added this question as a 3 marks, totally 7 marks. Very clear? So we already discussed about one thing called actual return is not same as expected return, right? So why this not equal came means because of risk. Because of risk. If there is a no risk means that not equal be converted into equal. Are you clear? So we have a different types of risk. Because of the different types of risk, my actual outcome is not same as a expected outcome. Hope you guys understand the sentence. The actual outcome is not same as expected outcome because of different types of risk in the market. Let us check that. So the types of risk, variation in the return due to, what does it mean for variation? Difference. Are you okay? Now, so if every point go with the sentence, actual outcome not same as expected outcome because of interest rates. Because of interest rates, that risk is known as interest risk. Guys, clear? Repo rate, reverse repo rate also affect your transactions. Can be controllable, country specific. It's not for our particular company point of view. It's about general industry point of view. Are you clear, sir? Next sentence. Actual outcome is not same as expected outcome because of fluctuations in the security market. Because of what, sir? Fluctuations in the security market. Can I use the word security market means share market? Are you clear? That risk is known as market risk. Next, actual outcome is not same as expected outcome due to changes in prices of all commodities. Changes in all commodities. What does the word mean, commodity? Goods. What are the goods we're using day to day life? Are you clear? So you learned in foundation level inflation. Guys, clear? Due to inflation also your actual outcome is not same as expected outcome. That risk is known as inflation risk or purchase power risk. Purchase power risk. Purchase power risk. Guys, clear? The next one, the actual outcome is not same as expected outcome due to activities undertaken by the organization. So the risk is known as business risk. Simple, man. If your CEO is not that much of knowledgeable person, he can take a good decisions or bad decision. Bad decision automatically impact your company. That's why expected is not same as actual. So actual is not same as expected. That risk is known as business risk. Can I use the word, can I control this risk? Business risk can be controllable. Why? Because it talks about my company. If that risk is in your hand, you can be controllable. You can't 100% eliminated. You can control. Then I will change the CEO position to another knowledgeable person or qualified person. Are you clear, sir? Then automatically things will be changed and things will be changed to good. Now the point, if actual outcome is not similar to expected outcome because or due to what, sir? Capital structure. Previously we followed equity. Now we are entering into debt market. That also risk only, na? So that risk is known as financial risk. That risk is known as financial risk. That's why I used a word called interest is a financial fixed cost. That's why you learned a concept name called leverage, financial leverage. Are you clear, sir? So the financial leverage alternative name is financial risk. Next, actually is not same as expected due to risk associated with the secondary market. Secondary market in which the security traded is known as what, sir? Liquidity risk. So in a liquidity point of view, we are not focusing on the primary markets, we are focusing on secondary market for selling the goods. Guys, clear? Next, so you already know systematic risk and unsystematic risk. Which one is controllable, which one is uncontrollable? Systematic is uncontrollable or undiversifiable. We can't diversify. When it comes to unsystematic, we can control or we can diversify. Guys, clear? So why? Because systematic risk talks about entire industry. Are you okay? Or entire country. That's why it's called country specific. When it comes to unsystematic risk, it talks about only your company. That's why it is known as a company specific. That you can controllable. Now computation of beta. Computation of beta. Beta measures the non-diversifiable. What does it mean for non-diversifiable? Systematic or unsystematic? Yes. So risk point of view, we are using standard deviation variance for calculation purpose, coefficient of variance for calculation purpose, 3 elements. When it comes to specific of systematic and unsystematic, beta is a measuring tool for systematic risk. In a total risk point of view, measuring tools are standard deviation, variance, coefficient of variance. When it comes to specifically talking about specific risk and systematic and unsystematic, the beta is a symbol for using calculation of systematic risk. Are you okay? Now we already completed one calculation part, I think. Are you clear, sir? What's the formula we used on that case? Covariance of security and market divided by standard deviation of security and market. Clear? So there is an alternative formula. There is not alternative, another formula is there. Anyone? Yes, exactly. Correlation coefficient. Correlation coefficient of market and security into standard deviation of security divided by standard deviation of market. This is the second formula we have to calculate. What's your beta? Clear? Done. We have a one MCQ. Write it down, that formula. Correlation coefficient of market and security and standard deviation of security and standard deviation of market. One MCQ is there. So out of 75 MCQs, only just 25 MCQs are came from the outside, sir. Remaining all are framed only based on that sentences, sir. Guys, completed. Next, sir, financial statement analysis. Use here. Refer chapter number 1. Refer chapter number 1. There is a few MCQ ratio based MCQs. That's the basic stuff you learned in the foundation. On intermediate of FM. Very clear? Remaining all discussion we will done next class in a chapter 1. Introduction to performance management. Okay. So put a star for illustration number 12, concept number 12. Market value and enterprise value calculation. So you already know the meaning of market value, estimated value. Are you clear, sir? At valuation date. When it comes to enterprise value, don't worry, it's a simple thing. Market value of firm is there, na? Market value of firm, unlevered firm point of view as well as levered firm point of view. Forget about the unlevered form. Why? Because equity is nothing but firm value. What about the levered form? Market value of equity plus market value of a debt, right? Very clear. The market value of firm is nothing but equity enterprise value. The word enterprise itself saying that company value. Very clear. But when it comes to the detailing of the calculation, as per capital structure, this is sufficient. As per capital structure, market value of equity plus market value of debt is sufficient. But when it comes to enterprise value point of view, when you first one you have to consider market capitalization. That is nothing but equity share capital. Market capitalization plus NCI. What is NCI? Non-controlling interest. If you have any shares in subsidiary companies, you have any shares in subsidiary companies, that also be your company capital. Guys, clear? Plus debt plus preference share capital plus preference share capital plus reserves and surpluses. Reserves and surpluses. Reserves and surpluses. Guys, clear? Now, out of this, you have to reduce the cash balance. Very, very important. So, equity share capital plus non-controlling interest plus debt plus preference share capital plus reserves and surpluses. Reserves and surpluses. Don't consider this reserves and surplus as an individual part. Why? Because this market capitalization is there now. It already included. It already included. That's why don't write separately. Are you okay now? Now the point is, sir, why you are reducing cash balance? Why you are reducing cash balance? Why I am reducing cash balance means the common sense is involved. If I purchase your company with the help of this logic, I will procure your cash also. I will taking your cash also. At the end of the day, transferring, I will send your money to you. Guys, clear? That's not a fair deal. For example, if I acquire your company have a cash balance of 1 crore rupees. I acquired your company for 500 with 7 crore rupees. Now, if I take all balance sheet elements, your company cash also, my company cash, na, I will repay that 1 crore to you. Very clear? So it's not a fair valuation. That's why when you are considering the balance sheet values, you have to reduce what, sir? Cash balance. Are you okay now? Done. Let's check out here. So enterprise value equal to market capitalization plus market value of a debt minus cash. It's a basic version formula. If you decode this again, common shares, that is nothing but equity share capital plus reserves and surpluses is known as common shares plus preferred shares, that is nothing but preference share capital plus minority interest, that is nothing but NCI, non-controlling interest plus market value of a debt. Are you clear, sir? Minus cash and cash equivalents. Clear? Now, value of equity. So it means I understand one thing. Equity value is different. Market value of equity is different. Yes or no? Na? Why? Because it includes debt value, preference share value, etc. etc. But I want only market value of equity. So enterprise value minus value of liabilities, that is nothing but debt, minus value of preference share capital. So you will get what, sir? Equity. It means common shares, preferred shares, minority interest. All three is known as equity. I will give one clarity. Previously, I provided clarity between equity share capital and equity, right? That name, just for understanding purpose, I explained. It's not a clear term. So when it comes to equity share capital, you know that amount you invested. When it comes to equity share capital calculation, what? Equity share capital plus reserves and surpluses, right? Plus preference share capital. Why preference share capital means I already expressed preference share is a hybrid security. Very clear. Even though there is not a true owner, we are treating them like a owner. That's why we provided preferred payment. Are you clear? Net profit is a owner's profit. As a owner, I am not sharing. I am providing money to preferredly to you as a preference shareholder. That's why even though preference share capital is an outside person money, we are assuming it is our organization person money. That is nothing but we are treating them like a owners. Are you clear, sir? Very, very important concept, sir. So if there is a no preference share capital, what is meant by equity? Equity share capital plus reserves and surpluses. If there is a preference share capital, so if you understand another thing in clear, I will give a clarity in chapter 1 at the time of ratio analysis. You know the name of net assets. Are you clear? Total assets minus external or outside liabilities. Are you clear? Now what is the total assets? All sum of all assets of the balance sheet minus external liability means what? Current liability plus long-term liability. Long-term liability. Here we are not taking preference share capital. Are you guys clear? Huh? Why? Because the amount in your hand is known as net assets. It is also be known as equity. It is not also be known as equity. It is also be known as net worth. It is also be known as owner's fund. Guys, clear? I will give a clarity in next class. So anyway, come to here. So equity means simple term internal capitals. What does it mean for equity? Internal capitals. We have an internal capital as well as external. Equity share capital is a internal capital. Minority interest is a internal capital. Reserves and surplus is a internal capital. Preference share capital is a internal capital. Guys, clear? What about the debentures? External capital. What about the term loan? External capital. Out of 5, we have a 3 are internal, 2 are outside. Very clear? Sum of internal capital is known as equity. Okay, sir. If you investing in your subsidiary companies, as a company, I am investing in I have a subsidiary company, but we are recording at shares point of view. So if you preparing consolidating financial statements, what you record in shares, you will record only your company shares or subsidiary company shares also. That's point of view. Are you clear, sir? Done. Now when it come to, so why this much of clarity I provided here means, so here your student will get a doubt. Guys, clear? Now when it come to estimation of investment decision, sir, what I explained is different, what they given is different. What I explained is you will get any questions. So in equity point of view, you have to consider what? Preference share capital also. But here they deducted. So in simple terms, equity share capital term is there, equity shareholder fund is there, equity is there. 3 terms is there. Are you okay now? Okay, done. Now when it come to estimation of investment decision techniques, so you already know this payback period means. What's the mean for payback period? How many days it will take recover my investment? How many days it will take to recover my investment? So average rate of return, how much I am getting from that project? NPV, I already explained in previous class. IRR, I said I will explain at the time of YTM model. Profitability index is as simple as NPV. NPV expresses in rupees answer. PA expresses in times answer. Present value of cash inflow divided by present value of cash outflow. So computation of cost of capital completed. Computation of KE under CAPM is completed. Computation of KE build-up model is completed. Computation of KD is completed. Computation of value of share at present date as per perpetual dividend. Highlight, observe the word present date as per perpetual dividend. I said now we are not multiply with the present value factor. We are calculating V naught at current period only. For illustration number 7, 8, I think. Even though it's a perpetual long-term period, we are not multiplying with the present value factor. Why? Because we are calculation at which date? Present date. That's why it name V naught or P naught. Next, computation of value of share at present date as per Gordon's constant growth model. So this also we done D1 divided by R minus G. You can observe they're not using a word called KE or KO. They're using a word called R, required rate of return. Meaning is same, names are different. Now when it comes to computation of value of share at a present date as per not constant growth model. So that's it, guys. When it comes to chapter 5, open MCQs. I shared in your group, sir. So MCQ number 1. The price that would be received to sell an asset or paid to transfer a liability in orderly transaction. Highlight the word orderly transaction. Measurement date. Measurement date. I also expressed in previous class received or paid. What's the mean for received or paid? Actual or not? Actual or estimated? Can I use it as a fair value? Based on this decoding only we can answer. Guys, clear? So fair value. So if you get a material, don't tick like this. Just observe and leave it. If you have any special points, record in your notes as a number of based on a specified number of MCQ. Are you clear, sir? So if when it comes to preparation of MCQs, take one rough paper, put that numbers and write down the options and go and cross check with the key I provided. Are you clear, sir? If you tick or if you solve here itself, next time you can't think the logic of that MCQ. Okay. Now MCQ number 2. This is the estimated price. This is the estimated price for the transfer of an asset or liability between identified knowledge bills. Respective interest. So what value it is? What value it is? Go and check the equitable value definition. I said now, clerical things. In yesterday class, I explained, sir, look like they both definitions are similar, but there is a slight difference. Now, what is the answer? Equitable value. Now, when it comes to MCQ number 3, liquidation value can be determined under what premises? Both are. So, orderly transaction as well as forced transaction. The both are correct. The best is both. So when you are solving MCQ, you have a correct answer as well as best answer. You will get a marks for best answer. Now when it comes to MCQ number 4, the amount that would be realized when the asset or group of assets are sold on piecemeal basis. What, sir? Yes or no? No? This is a keyword we have, piecemeal basis. Liquidation value. Now what about the MCQ number 5? Companies that grow and earn a return on capital that exceeds their cost of capital create a value, said by Alfred Marshall. So it's in the top of your material, top on your material. Now when it comes to illustration number 6, the price a willing buyer would pay a willing seller in a transaction on the open market. Open market. Open market. Open market is a keyword for fair market value, but there is a no option. There is a no option. So I already said correct answer is there, best answer is there. If there is a no option means they need to give an option called none of the above. If not given none of the above means they're expecting answer from the 4 options. Are you clear, sir? So the replacement word of fair market value is market value here. Put a star for that MCQ. Are you clear, sir? As per definition, what is the right answer? Fair market value. There is a no option of fair market value. You have to choose one. Then choose the best one. Which one is the best one here? Market value. MCQ number 7. Fair value is defined as the price that would receive to sell an asset or pay to transfer a what? Liability. Yes. In orderly transaction between market participants at measurement date. So just one word is missed. That word is nothing but what, sir? Liability. Answer B, Bombay. Now what about the 8th MCQ? The current use may be, but is dash also the highest and best use. The current use may be, but is not necessarily a, go and check highlighted word of current use and existing use. Current use and existing use. Not necessarily. Not necessarily also the highest and best use. The meaning of the sentence I explained 2 times. It's not focusing on the estimation or future values. It's focusing only on present or current usage. So not necessarily. What about the MCQ number 9? Dash is the use that would produce the highest value for an asset. Highlight the word highest value of an asset. The word highest value means not about the 12 months, it's about the more than 12 months. Current use, existing use, best use, highest and best use. Option D is the answer. Next MCQ number 10. In orderly transaction, the reasonable period of time to find a purchaser dash vary by asset type and market condition. Fill the 4 options in that fill in the blank, you will get a clarity. Yes, no, may not. Yes, no, may not. Before that, understand the question. If I provide a reasonable time period, the values will be vary or not is the question. Is may be vary or not to be vary. Clear, sir? Answer C. It's like an English class, na? Okay, done. 11th one. The dash elements of going concern. Yes, I listened one word going concern. It talks about intangible. Go and read the entire question. The dash elements of going concern value results from the facts such as having a trained workforce. Can I use the word HR? Tangible or intangible? Operational plant. They're not talks about the plant. They're talks about the operation on plant. There is a difference, sir. Operation plant is an intangible thing. We can't see that operations. It will run. Now, the necessary licenses, you can take copyrights. Next, marketing systems and producers in a place, etc. What's the answer? Intangible elements. Now, illustration number 12. The valuation approach inputs and assumptions applied are highly dash and selected premises of value. Dependent, independent, slightly dependent, none of the above. Simple. Approaches are depends on the approaches are depends on the premise. Situation is there now, that is nothing but premise. Premises or not is the question. Is depend or not depend? It's depend. That's why we framed the first checklist. Guys, clear? So valuation approaches or inputs or assumptions highly depend on. Yes, very clear. First you know the premise, then only I said choose the approach. If you choose the approach, then decide the method. Guys, clear? Next, tangible assets are usually valued using any of the premise except. Yes, note number 2 or 1, I think. What, sir? Tangible assets you can use any of the premise except going concern. Going concern only for intangible things. Next, which of the following approaches to valuation would most like to use EV to EBITDA multiple? Ratios only for company comparable multiples. Clear, sir? Now, for evaluation, strategic performance management, this is not a stuff, sir. This is a material side of the material board book. When you're dragging the concept, this also came in board book. Side heading is there now, Institute of Cost Accountant, SPMBV. It is not a question. Up to here only the question. So enterprise value to EBITDA multiple, where you used which method, which approach or method? Approach. In which approach you are using? Market approach. Which method you are using? Company comparable multiples method. Now what is the answer? C. Now illustration number 15. When to apply income approach? When to apply income approach? In all cases. In all cases. Yes or no, sir? What is the first case? Where the asset does not have any market comparable companies. Yes. At that time we are using income approach only. Where the asset has a fewer relevant market comparables. Yes. At that time also I am using income approach. Where the asset is income producing asset for which the future cash flows are available and can reasonably be projected. Yes. In these all situations I will choose income approach. All the above is answer. Now what about the illustration number 16? Key inputs of discounted cash flow method. Cash flow, terminal value, discount rate, all of the above. Cash flow, terminal value, discount rate, all of the above. As of now, understand discounted cash flow method means NPV. Up to now, just understand discounted cash flow method means NPV. So for NPV calculation, what is the requirement? Cash flow is requirement, terminal value is requirement, and discount rate is requirement. So all the above are the requirements. MCQ number 17. Dash is the value of an asset, business or a project behind the explicit forecast. Highlight the word behind the. Behind the explicit forecast period where the future cash flows can be estimated. So we have two types of benefits. One is operational benefit, another one is terminal value. So operational benefit we will receive only for forecasted period, either 10 years or 20 years or 5 years or 4 years. From at the end of the forecasted period to perpetual life receiving value is known as a terminal value. Alternative name I already explained in last class. Terminal value or forecasted value. Not forecasted, estimated value, for terminal value or perpetual value. Guys, clear? Now what is the answer? Terminal value. Sometimes instead of terminal value they will use a word called perpetual value. Next, illustration number 18. If business is financed slowly through equity, it is not KC, sir, it's a KO. The business is financed slowly through equity. KO is the same as. Sir, this question asked in December 23, sir. In exam. Guys, clear? So cost of equity. Now Illustration number 19. Cost of capital represents a dash benchmark rate that company must overcome before it can generate value for its financiers. Minimum or maximum or at least. So maximum is not a answer. None of the above is not a answer. We have only two options. Minimum, least. Are you clear? So the words are similar words. Minimum or at least. But in that situation, you have to take a best stand or best answer. You have to choose a best answer. What is the definition? It is a minimum rate of return company need to earn. That's why I explained the definition. Guys, clear? Both are right answers in individual perspective, but when it comes to the collective perspective, the best answer is minimum. Hope you guys clear? Sir, it's not my agenda is not explaining the MCQ, sir. My agenda is how to answer the MCQ. Are you clear? This all basic stuff, you know how to answer this. Now when it comes to illustration number 20, in case the business is expected to mature at the end of the explicit forecast period, the terminal value may assume that free cash flows will continue for dash thereafter. How many years? There is no specific year, infinite years. Now when it comes to 21, PEC means profit earning capitalization value, sir. Second method of the income approach. Earning capitalization is there, na? The full form for PECV is profit earning capitalization value. So PECV of capitalization of earnings method is a simplified application of which approach? Income approach. Next, when it comes to when to apply cost approach. When to apply cost approach? When to apply cost approach, guys? In all situation, we will choose what? Cost approach. Next, when it comes to MCQ number 23, put a star. It's a new MCQ. Keep in your mind the name. So you already know the father of economics. Alfred Marshall is not a right answer. Adam Smith is the right answer. Alfred Marshall is a father of microeconomics. Guys, clear? Here not asking about the economics father, is asking about a finance father. The finance father is Harry Markowitz. Very clear, sir? Keep in your mind. It's not a concept. Very clear? Done. When it comes to MCQ number 24, expected rate of return for any asset is a dash average rate of return. Simple or weighted? Simple or weighted? Weighted. Specific sentence is there. Risk and return go hand in hand considering dash. Risk and return go hand in hand considering dash. At the time of investment, I will check risk of the investment as well as return of the investment. At the time of finance also, I will check risk of the finance and return on the finance. Two decisions is there, na FM. Investment decision. First one is finance decision. At the time of finance, you have to check risk of the finance as well as return on the finance. When you put investment in your company, on that case also you have to check risk and return. But at time of finance, we will majorly focusing on risk. At the time of investment, we majorly focusing on, but we will check both. Guys, clear? But we will give a importance more. Now the answer is both. When it comes to MCQ number 26, higher the risk, dash is the expected return. Why? Because they both are directly related. I think the key is wrong. Rectify after getting a material. Next, when it comes to illustration number 27, dash risk due to change in prices of all commodities. Sir, if it is a security prices, market risk. If it is a commodity prices, inflation or purchasing power risk. Don't confuse. If it is a secondary market prices, it is called liquidation risk. Three risk talks about prices, sir. One is security price. It means share price. It's called market risk. Another one is commodity price. That is nothing but goods prices. It's called inflation or purchasing power risk. Another one is called secondary market price. That is called liquidity risk. Are you clear? Now, what the answer here? Inflation risk. Sometimes they will give option B purchasing power risk, option C both. That kind of tactics they will play. Are you clear, sir? Alternative names are very, very important. Now, when it comes to illustration number 28, liquidity risk is associated with the dash market in the securities traded. Liquidity risk. Which market? Primary market is known as market risk. Share prices, primary market. When it comes to the liquidity risk, it talks about secondary market. Unsystematic risk is also be known as. Answer is wrong. Option D is right. I already said. Option A. Yes, diversifiable as well as avoidable. The best answer is both A and B. Simply will lose 2 marks. Yes or no, sir? Even though your answer is A, go and check D also. After completion of all options, you have to decide which one is the right answer. Next, formula to calculate enterprise value. Market capitalization plus market value for debt minus cash. Yes, correct, but I can't decide is the best. Okay. Market capitalization plus book value for debt minus cash is the wrong answer. Enterprise value talks about only market value point of view, not on book values point of view. I am not use the word any book value at the time of explanation. Next, market capitalization, book value, it also be wrong answer. Market capitalization, market value of market capitalization and market value of equity both are same. If you do like this, it's a double impact. Wrong answer. Now, which one is the right and best answer? A only. Next, MCQ number 31. As the amount of debt increases, the present value of dash. So, net tax shield benefit of a debt increases. Yes, I will agree. Why? Because if debt increases, as per MM approach is there. As per MM approach, firm value calculation, debt into tax rate is there, na? Debt into tax rate. Okay, leave about this. If debt increases, I have to pay less interest or more interest? More interest, na? If I am reducing more interest from the profit, my taxable profit reduced by more or less. That's why I will get a more tax advantage. Guys, clear? Yes, it's a right one. Check the B. Bankruptcy and agency cost decreases. No, sir. That is not talks about bankruptcy. Next, net tax shield benefit of debt decreases. Not decrease, sir, it increase. Wrong answer. The company increases. No, the company is not increases. Now the answer is net tax shield benefit of debt increases. Now MCQ number 32. Which ratio reveals the number of times company can make its interest payment from its operating profit? Put a star. You will get a clarity on next chapter. You know, na, already learned in your Inter FM. Interest coverage ratio. Interest coverage ratio. What is the formula for interest coverage ratio? EBIT divided by interest or interest divided by EBIT? EBIT divided by interest. For example, I have 100 lakhs of EBIT. I have to pay 10 lakhs interest. What is the answer? 10 times. It means for every 1 rupee, they have a 10 times of money to repay. Are you clear, sir? For example, I have a EBIT 80 lakhs and I need to, a company need to pay interest 10 lakhs. What is the answer now? 8 times. What does that mean for 8 times? Company have a settle to 1 rupee of interest, they have a 8 rupees. Yes or no, sir? Okay, done. So, what is the answer? Interest coverage ratio. which is the most important ratio for shareholders who can assess how much profit has the company earned by using the shareholders funds. Shareholders, a return on capital employed equals to EBIT divided by capital employed. Return on debt equity ratio means total debt divided by total equity. Return on equity means EAESH divided by equity. Net profit margin means net profit divided by sales. Now the net profit divided by sales not talks about the bonus fund. Cancel. Now return on debt equity ratio also not talk about the profits. Cancel. We have only two options. One is return on capital employed, another one is return on equity. Now the capital employed equals to equity share capital plus reserves and surpluses plus preference share capital plus debt. Very clear? They are asking about only whom fund. That's why here it preference shareholder fund as well as debt. Option A is wrong answer. Which one is right answer? Return on equity. Guys, clear? So return on capital employed is here talks about entire organization profit. Return on equity talks about specifically equity shareholder profit. Now when it comes to illustration number 30, MCQ number 34. High PE generally reflects dash risk and or dash growth prospect for earning. So I already explained PE ratio. We need to think in two perspectives, investor point of view as well as company point of view. If question is silent, you have to think on company point of view. Why? Because you are learning all this chapter for a company purpose only. Guys, clear? They both are opposite. We need to stand one side. The standing side is a company always. If they specify the investor, think investor point of view. Remaining all cases, you have to think on company perspective. So right here, company point of view. Now what is the answer? The high PE generally reflects a lower risk and a high growth perspective. That's I explained in yesterday class. MRF and CET. Now when it comes to MCQ number 35, the price earning ratio is calculated as basic formula MPS divided by EPS. On check up to 4. Why? Because sometimes they will give market value of equity divided by EAESH. Total point of view also they will give. It also gives the same answer of PE. Are you clear? But here not given. MCQ number 36. Dash is the typical price a product fetches in an unregulated market. Highlighted the word unregulated market. The price typically is known as value. They both are not same but typically known as price or value. Next, when it comes to MCQ number 37, which of the following approaches to valuation would most like to use a price to sales multiple? PS multiple. All multiples we are using it covered under market approach. Now which approach it is? Market approach. MCQ number 38. If the expected rate of return or a stock exceeds the required rate. So first go with the numericals. The expected rate is 12%. Exceeds means more than the actual return only, na? So that's why required return is less 10%. The stock is good to buy. Option D. Sirs, overvalued, undervalued concept is there, na? Overvalued and undervalued. That concept it is. I said that calculation of illustration number 11, I think. Sir, what you calculated is known as expected. You have to compare with that value. It means you have to compare with 12 to 10 or 10 to 12. 12 to 10. Maximum how much I will receive? Expected rate of return of stock exceeds required rate, sir. Expected rate of return is stock exceeds required rate. Minimum that company generate how much, sir? 10%. But what's you're expecting? 12%. Are you clear, sir? So if you calculation part is greater than 12%, you are expecting minimum 10%. If exceeds means that value of share is better now. If you purchase that share, I will get a 2% extra. Now the answer is the stock is good to buy. Now when it come to illustration number 39, valuation done under enterprise model, that is nothing but DCF, discounted cash flow method. Discounted cash flow method and economic profit model lead to identical results. So this economic profit model is nothing but earning capitalization, sir. Earning capitalization. So in net income approach, two methods we have. What are the two methods? Discounted cash flow method and earning capitalization method. Why they put the two methods in single approach means it will give a similar identical answers. Now what is the answer? Statement is true. Now put a star for that MCQ, sir. MCQ number 40. In inventory turnover calculation, what is taken as a numerator? Do you know the turnover ratios? Turnover ratios. So turnover ratio is also been known as activity ratio. If you don't know about this turnover ratio, for no issue, don't worry, I will explain. So when it comes to turnover ratio, always numerator sales. Always numerator sales or turnover. But when it comes to cost point of view elements, you have to consider cost to turnover. Cost to turnover. I will give a clarity at the time of activity ratio explanation. So here the cost to turnover is cost of goods sold. Cost of goods sold. Now when it comes to illustration number 41, when valuation process is under multiple scenarios, you take into consideration multiple scenarios. So at the time of valuation, I focusing on scenarios as well as range of values. Why? Because for one type of valuation, I will use multiple methods. Multiple methods. There is one of the problem in our chapter 6. Calculate the range. The word range means maximum value, minimum value. So seller point of view, they need minimum. They need minimum this much. Purchaser point of view, I can purchase with the maximum of this amount. I can't more that maximum. Guys, clear? So the word minimum maximum is known as range. The word minimum maximum is known as range. Are you clear, sir? Are you agree for the seller saying value? Are you agree? You are not agree. Seller also not agree about the purchaser value. They will negotiate between the two values. One is minimum value, another one is a maximum value. That's called range. So the answer is both, sir. Range of a value and scenarios. Range of the values and scenarios. Now illustration number 42. Does either the NPV for a free cash flows model subtract the value of debt in its calculation? Value of a debt concept is not involved in NPV calculation. Here we are involving cash flows, weighted average cost of capital, terminal cash inflow, etc. The value of a debt we are using under capital structure approaches point of view, as well as market enterprise value point of view. We are not using under discounted cash flow method, neither the NPV nor free cash flows models. Next, MCQ number 43. Beta measures dash risk. Systematic only. Sometimes they will give systematic and unavoidable risk. That time you have to choose both. Here I think they not give that like that. They provided systematic and the unsystematic. Sorry. Oh yeah. Non-diversifiable is given na. So option A and B both are correct. So what's the best one? Both A and B is the right one. Both A and B is the right one. Now when it comes to illustration number 44, fair value is defined as the price. So just they missed one word, that is nothing but orderly transaction. We highlighted that word also. Keyword, orderly transaction. So missing sentences. Now illustration number 45. Please solve and tell me. When it comes to 17, so dash is the value of an asset, business, or a project behind the explicit forecast. So at the time of explaining Gordon's model, I used two words. One is forecasted period, another one is a perpetual period. The word perpetual period is nothing but infinity life. Very clear. So if completed per forecasted period, you will get a behind the life. That is nothing but perpetual life. The perpetual life calculation is known as perpetual value or terminal value. That's why option C is the right one, terminal value. What, sir? 235. How many of you calculated this 235? Speed up, guys. The illustration MCQ number 40. Right. So what's the given information? So first dividend 15, second dividend 16. Go and check, the years are important for this calculation. So after 2 years means, can I use here D3? 16 is the D3. What about this 15? So after 3 years 16 means, what about the previous year? Second year only now. It is called D2. Guys, clear? Now when it come to V0 equals to D2 into present value factor plus D3 divided by R minus G into present value factor. Why? Because the D3 talks about perpetual life. Now please tell me D2, 15. So before that you have to figure out KE, I think, as per CAPM approach. So KE please. 12.65%. Directly I am writing the answer. Why? Because CAPM, RF plus beta into RM minus RFA, or only risk premium. Risk premium, you can go with the beta into risk premium. So the answer is 12.65. Now please tell me the present value factor for 2 years. $0.788 plus D3 please 16. What is the required return? K is nothing but required return. 0.1265 minus G 0. Sir, they already specified estimated values. That's why directly taking D3, D2 and D3. If not, they're saying estimated values, I can convert them into estimates. Now please tell me present value factor for which year? Third year or second year ending? Second year ending. Second year ending. Third year beginning to infinity life. Third year beginning to infinity life. So which year end it is? Second year end. So again it is a 0.788. Now please tell me the D3 second year value. 15 into 0.788. What, sir? 15 into 0.7. Oh, this one, huh? How much, sir? 223.15. What about this, sir? 15 into 0.788. 11.82. Now please sum these two. So approximately you can take 235. 235. So come to illustration number 46. So just a calculator calculation. Cable. So you will not get a approximate answer. You will not get exact answer. You will get approximate. They are expressed closest. So weights of equity is a difficult thing. Remaining all are easy. MCQ number what it is? 46. Now you can observe debt is to equity. They expressed 2:1. So weight of equity equals to 1/3. Weight of debt equals to 2/3. Speed up. Don't take 8%. Out of 8 you have to consider only 70%. 1 minus tax is there, na? KD, pre-tax or post-tax? Unless they specify, it's a pre-tax. 7 point. So generally what answer you will get, sir? 0.66. They said take closest to 2. 7.07%. Now when it comes to illustration number 47. Illustration number 47. A firm has a PAT of rupees 33.66 lakh with extraordinary income of 6 lakhs, cost of capital 20%, applicable tax rate is 40%. The value of the firm. The value of the firm. $150. So these all are exam MCQs, sir. MCQ number. MCQ number 47. Listen. Based on the information, value of firm equals to PAT divided by required rate of return. PAT divided by required rate of return based on information. So what's the, I think PAT they given a how much? Okay. Required rate of return is given a 20%. If you solve, you will not get answer. Please solve. Tell me the answer. 168 is there? Yes. If you choose this, you will lose 2 marks. Guys, clear? Sir, if they not use a word called extraordinary income, then what you calculation is right? Very clear? So if they give the extraordinary income means this 6 lakhs already adjusted in PAT. When you're doing a valuation, you are not consider that extraordinary incomes. It came only once in a lifetime values. Don't take that values in valuation. Clear? That's why you have to reduce from the PAT. Reduce from the PAT. Now PAT, it came because of extraordinary income. Why? Because PAT is also been known as net profit. How you get net profit? After deducting extraordinary income or before deducting the extraordinary? Hope you guys clear? Previous one what? PBT, profit before tax. Okay, done. It is a 6 lakhs. What about the PAT? 33.6 lakhs. Wait. PAT. So in between the PBT and PAT, the main important thing is tax. Guys, clear? Okay, done. Now check. What about the PAT? So we start from the PAT. Amount please. 33.6 lakhs. It came because of less extraordinary income of rupees 6 lakhs. It came because of tax deduction. I don't know about the amount, I know the percentage. At the rate of 40%. So the main figure is known as PBT. Now see, if I know PBT, I can easily reallocate that source. Very clear, sir? Now the common sense of a subject, PBT always shows 100% of value. Out of this, we are reducing tax at the rate of 40%, that equivalent to PAT, pending percentage. Out of 100, 40% tax completed. What is the pending portion? 60%. The 60% value is equivalent to 33.6 lakhs. 33.6 lakhs. Now I want PBT at the rate of how much percentage? 100%. So now PBT equals to what? How much, sir? 56 lakhs. Less extraordinary income. How much? 6 lakhs, sir. The point is you have to understand, are you reducing a tax or not? Before extraordinary income or after extraordinary income is the point. You need to pay tax now. Extraordinary income is a tax eligible or not is the point. It not eligible or not? Not eligible. So that's why first you can deduct or not deduct. Extraordinary income is tax eligible, sir. You already readjusted now. You already they gain the tax. That's why you have reallocated it, included. Very clear? That's why you have to reduce extraordinary income of 6 lakhs. After you will get a taxable profit. Sir, we are just readjusting the values, not deducting the tax. So how much is the taxable profit? 50 lakhs. Out of this you have to pay tax. How much, sir? 20 lakhs. You will get a net profit. How much? 30 lakhs. Divided by, so you can go on right here. 30 lakhs divided by, what is the required rate of return? 20%. Now what is the answer? 150 lakhs. This is a way 150 lakhs is came. Without knowing this concept, we already taken the tax advantage in extraordinary item. Very clear, sir? That's why this patties came. Now we are readjusting that extraordinary item. Actual patties came. Very clear, sir? Now when it come to MCQ number 48, we will discuss after the break. Take half an hour break.